Hello, a very warm welcome to everyone joining us today from different time zones across the world. My name is Ritu Walia and I work as a manager at auctusESG. I will be the MC for today's session. Today's webinar on financing a just transition in emerging markets, the role of NBFCs, financial policies and regulations, is organized under the aegis of London Climate Action Week and is a joint initiative by auctusESG, Joint Impact Model or JIM Foundation, and Grantham Research Institute on Climate Change and the Environment's Just Transition Finance Lab and London School of Economics and Political Science. Today's webinar seeks to unpack the regulatory barriers hindering just transition investments by NBFCs in emerging markets by fostering a dialogue on actionable policy solutions and financial instruments to mobilize capital at scale. To begin with, a quick introduction of the organizers of today's webinar. The Joint Impact Model Foundation is a non-profit organization established by several international financial institutions in May 2022 that develops and maintains the JIM, a web-based tool enabling financial institutions with portfolios in emerging economies to report and assess their financed greenhouse gas emissions, job creation, and contributions to GDP. The Just Transition Finance Lab, hosted by the Grantham Research Institute on Climate Change and the Environment at LSE, supports the transformation of the global financial system to achieve progress on climate and wider environmental goals through a people-centered approach. With the goal of being a center for experimentation and excellence in the financial solutions needed for a just transition, the lab intends to show how the just transition can be both possible and investable. auctusESG is a global advisory firm specializing in sustainable finance, climate transition, ESG, and climate risk management. Led by senior bankers, it has completed 28 projects across 18 geographies. Its clients include government, UN agencies, DFIs, and organizations like the World Bank. auctusESG has also trained over 2,000 banking officers in climate risk management across India, Latin America, Central Asia, and APAC. Now, a few quick announcements before we start. We have an exciting lineup of speakers, so I would request each speaker to observe the prescribed speaking time. For the participants, please key in your questions in the Q&A box on the screen, and the moderator would take them up suitably. Moving on, I would like to extend a warm welcome to our esteemed speakers joining us today. First, we have Nick Robbins, who is a leading expert in sustainable finance and climate policy, currently serving as professor in practice for sustainable finance at the Grantham Research Institute, LSE. He also chairs the Just Transition Finance Lab, which focuses on aligning climate action with social justice and nature restoration. With over 30 years of experience, he has held leadership roles at UN Environment, HSBC, and Henderson Global Investors, shaping global sustainable finance frameworks. Nick is a co-founder of influential initiatives like Carbon Tracker, Planet Tracker, and the Financing the Just Transition Alliance. He has authored several key publications, including The Corporation That Changed the World and The Road to Net Zero Finance. A trusted advisor to governments, investors, and central banks, he plays a key role in driving equitable and resilient climate finance solutions worldwide. Over to you, Nick, to set the context for today's session.
Well, thank you, Ritu, and very good to be here. And I'm sitting in London, so welcome to London Climate Action Week. It's fantastic to have this session actually about emerging markets in London, because London is really hoping to be a centre and a partner in terms of mobilising the finance we need for emerging markets, particularly in terms of external flows of finance. And we need $1.3 trillion of external finance by 2035. So just to set a context for this session, and it's fantastic doing this in collaboration with auctusESG, the Joint Impact Model, really about the imperative of the just transition. We know we have a climate and nature crisis, and as we respond to that in terms of mobilizing lending and equity investment, we know we need to do that in a way that is just, fair, inclusive. And this is the theme of the just transition. We don't have two transitions, a regular transition and a just transition. We need to make sure that these issues of social justice, gender empowerment, and community empowerment are incorporated into core financing models. And that's the focus of today. In terms of the work of the Just Transition Finance Lab, which we set up last year, Our aim is really to maximize the social opportunities of the response to climate change, both in terms of net zero, but also in terms of building resilience, opportunities in terms of high quality jobs, in terms of gender empowerment, community empowerment. Secondly is also, if we're thinking about the just transition, to make sure that we're minimizing and managing the risks, because there could well be communities, workers, industries affected by this. We think maybe of fossil fuel sectors. How do we manage those risks so to ensure that particularly vulnerable communities are not impacted? And third, the key piece about a just transition is to make sure that key stakeholders, whether that's workers, communities, entrepreneurs, are involved in the process. So this is something which is owned by key stakeholders, and that process of stakeholder engagement is so important. Traditionally, the just transition has been thought of as coming out of sort of big sectors: energy sector, agricultural sector, industrial sector. But the finance sector has increasingly recognized its importance. Institutional investors, banks, but also here today, non-bank finance corporations, particularly those in South Asia. And we at the lab, we're looking at identifying particular financial instruments and strategies that are relevant for this. We want to identify metrics so we can measure performance and impact, which is why it's great doing this with Jim. We want to develop the policy frameworks. What are the financial regulatory frameworks? And then we want to profile case studies. And so we've got leaders on the call today who will give us some examples about how they're making this happen, whether that's in terms of NBFCs, but also crucially multilateral development banks and DFIs. In terms of our focus, we've been working on just transition finance in India for the last 3 years with a number of partners within India. And my colleague Sangeet Selvaraju is really our lead there. And we're looking in terms of our next phase to identify particular attractive working models in the NBFC, but also wider financial system in terms of making how we can deliver our environmental goals, but also do that with strong positive social impacts. So today's session, I hope we're going to be able to identify some of the emerging models, identify the impacts those are achieving, and then particularly identifying some of the reforms and changes we need in the frameworks to scale up this finance. So I'm very pleased to hand over now, I think, to Namita, who will be presenting the session and really listen to your experience and wisdom. Thank you so much.
Thank you, Nick. As Nick mentioned, we have Namita Vikas now, founder and managing director of auctusESG. Namita Vikas is an award-winning senior business leader and ex-banker with over 33 years of diverse experience in sectors across banking, finance, and technology. In her top leadership position with India's fourth largest private bank, she was instrumental in launching several first-to-market green and sustainable banking products, including India's maiden green bond, raising over $1 billion in green capital. An influential voice in sustainable finance and climate transition globally, she set up auctusESG in 2020. Namita continues to be a member of several expert committees and boards on sustainable finance and ESG, including those by Government of India, International Organization for Standardization, Climate Bonds Initiative, and the Finance Industry Advisory Board of the International Energy Agency. In the past, she has served a jury of the World Bank Development Marketplace Program, CPI Innovation Lab, Tata and Marico Innovation Awards. Namita will be presenting a case study on pathways to embed just transition and will also be moderating today's panel discussion. Over to you, Namita, to present the case study.
Thank you very much, Ritu. And as we bring up the slides, I just wanted to mention that I'm also in London like Nick, and welcome everybody. There is a kind of a thing in the air about the topics that we are talking today on maybe the streets of London, and I'm really looking forward to it. I would like to place special thanks to LSE, to the Jim Foundation, the LSE Grantham Institute particularly and my colleagues at auctusESG for putting in a lot of hard work to put this session together. And Nick, as you said, I fully agree with you that transitions cannot be too separate. Social justice needs to be embedded, into the transition that we are seeking, and we really need to look at the people who are getting impacted. I'm glad that LSE is also working on this. So is auctusESG and GIM. I think financial institutions play a pivotal role in enabling this transition that we are talking about. They're directing capital, they're setting the standards, they're influencing social and economic outcomes of climate action. And these become therefore super essential when we look at other granular institutions like the NBFCs, the sector by itself, that is serving a kind of a diverse medium, small set of businesses, marginalized customer segments, and their connect with the grassroots. They become a kind of a critical thread to the justice that we are looking at. And therefore, this topic today becomes absolutely important. So let's move on to the next slide and talk about the NBFC's landscape very briefly. From 70 trillion USD in 2004 to nearly 2040 US in 2023, NBFCs have been financing, their financing has grown remarkably. They're representing over 50% of the global financial assets. At the same time, large exposures to climate vulnerable sectors that employ some of the most marginalized populations in emerging markets and developing economies. I think a unique factor is the speed and the flexibility that NBFCs go to market with, unmatched by traditional banks. They're bridging the funding gap, mobilizing private capital, operating with co-lending models, and driving climate-focused investments in some of the underserved regions. They do have higher risk appetite, their adaptability is far better, and their customized financial solutions essentially deliver the needs of small borrowers and support of technologies or projects at the ground level. The increase in intensity in climate change and the demand on moving faster to transition, I think more attention needs to be given from all quarters, may it be governments, regulators, banks, the financial sector as a whole. And in my presentation today, I'm going to present a case study where auctusESG has worked with this NBFC to scale the impact and drive a transition that is not just looking at the business impacts, but also looking at how it can be evolved as more just and an inclusive organization. So let's move on to the next slide. And just to give you a very quick background of the NBFC, it is India's largest agri-enterprise, established in 2014, works with over 6,500 farmer collectives, 3,500 agri-enterprises, and 500 startups, impacting over 8 million farmers across the 28 Indian states, and over 100 agri value chains. It has a financial impact of over 3 billion US in transaction. Now, auctusESG was retained by a large multilateral which has financial exposure to this NBFC to develop their end-to-end sustainable finance, ESG, and climate risk management strategy and its overall implementation. So we essentially took up a 360-degree comprehensive approach to look at the scale, to build preparedness across the teams, and to identify existing and new avenues to attract more capital, and to look at how do you exit certain sectors. So let's move on to the next slide and look at what were the key activities that we undertook. This was a 5-phase kind of a project over 18 months. The first phase included a landscape analysis to identify the strengths and the gaps across businesses, policies, practices, particularly focusing at ESG climate factors to be aligned with governance, strategy, risk management, matrix and targets, of course, the TCFD approach. Given that their customer segments, key sustainability factors like diversity, inclusion, employee turnover, human rights, employee training, and associated risks and opportunities, all this was concerned because that's quite diverse in developing the materiality maps. Based on this data, in the phase 2, we built a very robust strategy for integration, kind of an integration stack that looked at integrating with business operations and targeted internal policies, integration, recalibration across loan appraisals, including credit approval memorandums, data collection, risk management strategies, understanding which issues require priority in operations, how capital needs to be allocated, how identification of transition portfolios need to be done, what are the other emerging opportunities. went into the third phase where there was a detailed guide that was developed, focused on non-financial disclosures, and a kind of a readiness was undertaken then to help them to strengthen their non-financial parameters and call out key data for disclosures. In the stage 4, which is very important, I mean, we see these are all regular credit and risk officers, and climate is a complex subject. So designing and deploying of training right from the board of directors to senior management to the operational and line managers, which was focused very much on systemic, institutional, and individual skill sets. And then we went into the last stage, which was the 5th stage, a robust communication strategy incorporating ESG and climate consideration at all touch points becomes very, very critical. And not just serving as a compliance or a public relations exercise, but as a strategic imperative for building the trust, managing the risk, attracting new investments, and driving a kind of long-term value. So the entire communication stack was put out for the organization to follow through. Let's go on to the next slide and look at what were some of the recommendations that we made. So these were very targeted recommendations that provided kind of a strategy to integrate and manage climate risk across corporate governance, internal controls, risk assessment, management and reporting, capital and liquidity adequacy. And if you look at it from, I have just culled out a few which looked at it, where I'm looking at more from a just transition perspective, but there were many more than what you see on the screen. So under governance, foundational building blocks were incorporated to make some immediate changes to enhance the accountability, transparency, and oversight. So board oversight processes to include ESG and climate risk identification, assessment, and communication as a part of MD&A by the management. Constitution of ESG and climate risk subcommittees chaired by the CRO, the Chief Risk Officer, and a board member, reporting to the RMC, the Risk Management Committee. ESG teams to support these committees along with officers from other departments, linking executive remuneration to climate targets. I don't think that's being done at a smaller organization level, and this was very important. Incentivizing the leadership to go beyond compliance and proactively support inclusive financial practices that drive livelihood resilience, and diversity by bringing in not just gender, but sectoral experts. I think that was very, very important. Under strategy, identification of assets and portfolios aligned to high emissions and a pathway to exit that, increasing of existing low carbon segment financing, like say solar pumps, new opportunities to be tapped as a part of the strategy, and business targets. All that was looked at. Prioritizing on gender equity and social inclusion in hiring, lending cycles, procurement, and inclusive social designs, ensuring that marginalized groups like women, youth, informal workers were covered under use of specific concessional credit lines that they already had. Bringing in the gender considerations, the diversity considerations by looking at developing women-focused loan products, structuring products to include vulnerable groups, and specific products for youth and entrepreneurs to encourage more innovation. I think one of the segments that was brought in was very important. Utilization of CSR and grant funds that they had. So in India, we all know that there is a CSR law where companies need to commit 2% of their profit for the past 3 years. So this was to train the borrowers on upskilling and reskilling. This was very important. So examples, putting together programs on green skill development, sustainable crop production, water and soil management, all this was taken into account. Moving on, risk management, which was the other part of recommendations. Their traditional risk frameworks lacked calculations on negative impact of climate and social shocks on borrowers' creditworthiness, especially given that they operate in the informal and the rural areas. So structures were created to incorporate ESG and climate considerations into their enterprise risk management, credit appraisal, capital adequacy processes, and within the non-financial risk assessment that was done. And this really helped them free up some of the capital towards transition measures, or at least identify what capital can go towards transition measures. What this led to was introduction to measures to quantify material risks, issues like diversity in the context of ESG and climate, carefully map the flow of ESG and climate risks through conventional risk channels in the ERN framework, and understanding the business processes, all this that may risk the damage or disrupt their balance sheets. Introducing types of mitigation measures that are available in the market, and assessing these to create the positive impact. So for example, they do have exposure to diesel pumps because they operate in agri. So how do you move to more financing of solar pumps, which not only mitigates the transition risk, but also look at the positive impacts that that would have on the lives of communities, on the lives of the users, and also building in a kind of business continuity rising from climate-related disruptions. Then matrix and targets were looked at, setting ESG targets across short, medium, long-term horizons that capture social impact like job creation, women's economic empowerment that happened because of the loans that they gave out, and access to sustainable finance. All this was key. We also brought in the social return on investment model for them to look at to evaluate what kind of social value they are creating by the lending decisions that they're making. So overall, I would say that this was a very holistic approach that was undertaken, and this entire exercise led to a new pre-series funding round from existing and new investors for the NBFC that were looking to place capital that matched their investment criteria. I think for the NBFC, the advantage was it strengthened its capital base and the financial position in the market, and provided a big business opportunity to access newer markets. Next slide, please. And that's really the last slide. So thanks a lot. But I thought that this was very important to share because I believe that undertaking just transition is not just a policy kind of an approach, but it needs to be a business imperative. And this could be one of the ways. This is a replicable model. This could be taken to market to take more. And we are looking at projects like that to work with more NBFCs. With that, I will stop and hand over to Ritu. Thank you.
Thank you, Navita. Moving on to the panel discussion, we have an exciting lineup of panelists whom I would like to introduce now. First, we have Christine Engstrom, Senior Director, Finance Sector Office at Asian Development Bank. Christine is responsible for managing a team that provides funding to banking and non-banking institutions throughout ADB's developing member countries in Asia and the Pacific, as well as trade and supply chain financing. She also supports private sector financial development with a focus on inclusive finance. Prior to joining ADB, Ms. Engstrom worked at Fannie Mae in Washington, D.C. as a senior manager in the capital markets group. She has also held various positions at the Overseas Private Investment Corporation and the International Finance Corporation, supporting private sector investments in Asia, Turkey, and Eastern Europe. Welcome, Christine. Next, we have Laya, who is the head of operations and engagement at the GIM Foundation and leads the GIM engagement program. She also manages projects in Latin America with DEG and a countrywide initiative in Bangladesh, sponsored by the FCDO as part of the Impact program. She is a passionate marketing professional who brings a sharp focus on brand strategy, demand generation, and purpose-led communication. At the GIM Foundation, she plays a key role in driving impactful, socially conscious initiatives that blend creativity with community engagement. With experience across both B2B and B2C landscapes, Laya is known for her strategic thinking and her commitment to building brands that not only perform, but also stand for something meaningful. Welcome, Laya. Next, we have Akif Chaudhary, Unit Manager and Sustainable Business Coordinator at IPDC Finance. With experience across corporate finance, sustainable finance, wealth management, and business strategy formulation, Akif is the Sustainable Business Coordinator at IPDC Finance and spearheaded the GIM FCDO Impact Carbon Accounting Training Program at IPDC. This comprised of 20 hands-on hours of both in-person and virtual sessions and exercises. Welcome, Akif. Finally, we have Abhishek Gupta, who is a finance professional with over 2 decades of experience in sustainable and impact investments. As former MD and CEO of Caspian Debt, he led the firm's transformation into a leading venture debt provider with high impact sectors such as agri, clean energy, and financial inclusion, while maintaining a strong credit track record and pioneering impact disclosures under frameworks like PCAF and the Joint Impact Model. He now serves on the investment committee of Dwara Holdings and the regional advisory committee of Aspen Network of Development Entrepreneurs South Asia. Welcome, Abhishek. Thank you everyone for joining us today. Without further ado, let's begin. Over to you now.
Thank you. Thank you very much, and welcome to all the panelists. I'm so glad to have you here with us. We have a very interesting 1 hour ahead of us where we're going to talk about how do you stay on course as a business entity at the same time? How do we make this transition inclusive, equitable, responsive to the local vulnerabilities? NBFCs are sitting at the core of all of this. There are several innovations that we are seeing in financing models supported by digitalization to reach the deep into markets which are very informal, underserved. And it's challenging because NBFCs do face complex regulatory landscapes. They have limited access to concessional capital, high credit risks because they are operating in low-income markets. So, we will unpack how NBFCs need to navigate these risks and pluck these opportunities that are laced by the climate smart lending that we are talking about. How do they go to exponential scale? So I want to go with my first question to Christine. Christine, with ADB's pivotal role in scaling up sustainable finance across Asia, it's taken multiple targets, adaptation, climate finance targets, adaptation targets. It would be really good to know how ADB is collaborating with local financial institutions, smaller institutions, to strengthen their institutional capacity and expand their lending portfolios, particularly in sectors where climate risks intersect with the livelihood risks. And what are some of the strategies that you are applying to ensure that these institutions can effectively manage the dual challenge of the vulnerability that we're talking about and financial inclusion that the communities are? Over to you, Christine.
Well, thank you, Namita, so much for inviting ADB to participate today. As we know, the poorest and most vulnerable, particularly women, are disproportionately faced with the heaviest consequences of climate events while having the fewest resources to adapt. So recent research shows that about only 10% of climate financing is reaching local levels, where the need is, of course, most urgent. So at ADB, we do recognize that non-bank financial institutions have a special role to play in addressing this finance gap, given that they are reaching out to many of these underserved segments. So at ADB, we work through both the sovereign public sector operations as well as our private sector operations to support the development and funding of the finance sector, including NBFCs. So what we do is we use a range of instruments. So that includes commercial-based financing for private sector NBFCs, concessional finance for sovereign entities and state-owned NBFCs, guarantees, regulatory and policy-based loans, blended finance, technical assistance for capacity building. So you see a whole spectrum of instruments to address the needs of NBFCs. So just turning to a few examples of how we address sustainable finance with our NBFCs and the types of instruments we use, I thought I'd illustrate some of our work through the first example, which is how we use guarantees with microfinance institutions. So about 15 years ago, ADB created our microfinance program in India, and it's now spread across all of our regions. And through that, we provide risk coverage on wholesale local currency funding from large commercial banks to microfinance institutions. So you can see that's a very powerful instrument to use to mobilize local currency financing. And some of our partners, for instance, include Standard Chartered, Citibank, some local large domestic financial institutions such as Indus Bank in India and such. Now, most recently, to address the climate change impacts on the most vulnerable, the microfinance program has initiated partnerships with about 8 or so MFIs in India to really mobilize and deploy private capital for climate change adaptation. So through this recent initiative on climate change impacts, we've been able to funnel about 88 million in climate change adaptation financing And that's right now benefiting about 340,000 small and marginal women farmers. We're going to be expanding to more partner MFIs, not only in India, but in other member countries. And to complement this activity, then we're also using what we call technical assistance, which would be for donor funding that we use for capacity development. And that's designed to enhance climate change awareness, support climate adaptation initiatives, and then enhance community level resilience through our partnerships with MFIs, and then with them to service their own customers. Now, this was underpinned by a climate change adaptation framework that we developed in 2024, amongst other activities with the MFP, the microfinance program, to integrate climate change risk assessment and adaptation planning in our MFI operations, build awareness of climate change issues, adaptation measures, and impact on micro borrowers, and develop new climate change risk adaptation products to provide risk coverage to micro borrowers under climate change related calamities. So that's one example of how we are working with microfinance institutions through one program, covering the usage of instruments such as guarantees, capacity building, and then knowledge sharing in terms of really helping them address some of these challenges. Now, on our sovereign sector side or public sector side of ADB, where we work directly with governments, for instance, we're currently working on a program in Papua New Guinea, where we're designing a green refinancing and guarantee facility. And that will work with local microfinance institutions to expand their capacity to finance green investments, specifically in areas like solar home systems, climate smart agriculture, and sustainable fisheries. So it's going to combine concessional refinancing and risk-sharing guarantees with this technical assistance to build capacity to help MFIs develop climate-aligned financial products, strengthen their credit risk management, which is very important, and then build robust impact tracking systems. And then lastly, I just want to note that there's a component to all this, especially in Asia, that we are starting to address and that really needs a lot of focus, and that is on insurance. And insurance to help build financial health or resilience for lower income people. And it's incredibly underdeveloped in Asia. So we're working on that as a growth area for ADB through development of the insurance markets to protect individuals, bring in disaster resilience tools, and then through the private sector, then fund insurance companies. So those are a few examples of the types of instruments we're using and the work that we're doing to help these vulnerable communities.
Great. I think that's a lot of information, and thanks a lot. It's very holistic kind of an approach that I see, especially the one in the Pacific, where it's not just bottom up, but it's also top down. When DFIs, MDBs do work with the sovereigns for them to put in certain measures together. So that's really good, and the tracking systems of the impact that you mentioned brings me to my second question to Laya. Laya, I want to know from you that the joint impact model does provide a valuable toolkit for quantifying social and economic outcomes across investment portfolios, because these are sometimes very difficult to quantify, right? And NBFCs do face significant data challenges in meeting investor expectations, especially from like just transition, social justice kind of matrix. So in your view, how does the joint impact model help bridge the gap between business realities, like the limited data availability, and the growing demand for robust, transparent impact measures from investors? So tell us some more about the features, the approach within the toolkit. How have you made it very effective in aligning with divergent expectations? Over to you, Laya.
Thanks so much, Namita, and thanks, Christine, for illuminating a bit on the topic. I see a lot of gym friends in the participants, so I'm not gonna over explain. But for those of you that don't know the gym or the Joint Impact Model, the GYM Foundation is a non-profit foundation. Our core activities are to host the GYM model and some projects. But in terms of the GYM model, what Namita was referring to, the GYM model is a model that is made available for financial institutions of any kind, DFI, and NDBs, NBFI as well. And what the tool enables you to do is you take a portfolio, you run it through the tool and you're able to get a calculation of your GHG emissions. But that's the basic, like everyone's calculating emissions right now. But the interesting part is that you're also able to quantify job supported and value added to the economy, or how much you are adding to the GDP. In terms of how this helps bridge this for NBFIs, I think I'm pretty sure Akif is the best person to give a full background on the challenges that NBFCs face. But from our perspective, working with NBFCs from all over the world, I think we feel there is a bit of like a core tension between the commercial viability and the long-term just transition goals. How do you balance, getting your goals and your targets, making money with the just transition? You have to align these two principles. And we also often feel that investors who are investing in these NBFCs are a bit disconnected from the reality, in the sense of like all the investors in all over the world, if I was an investor, probably want the same. They want to standardize impact metrics. They want to be able to compare. They want to be able to see what happens. This data is it's already hard to get in big banks. It's even harder to get in NBFCs when you're investing in MSMEs or kind of investments where you don't get the direct data. Of course, this is usually also paired, not always the case, but it's sometimes paired with limited capacity or maybe like limited resources internally to cover this. And this is what we want to help with. That's what the GIM Foundation core is. We have developed a fit for purpose tool. We only work in emerging markets or the global south. We don't cover OECD countries, those, complete different data needs. What we try to do is bridge this gap of data. The data is just not available. The knowledge is sometimes not available as well. What we want to do is, I don't know if it's the correct wording, but we want to be like knowledge brokers. We want to be able to share this tool, share all of our knowledge, leave it inside, and then go away, do it somewhere else. So the idea is with the banks we work with, for example, with Akif in IPDC, the idea is to give them the tool, give them the understanding to use the tool. Of course, this is a progress. It's not a one-day exercise, but give them this so they are able to assess how they are doing in terms of the just transition, how this is looking like in the financial side, and build a scenario where these two are cohesive and can develop together. So I think that's a bit how I will say the GIM is aiming to help here.
Great, thank you very much. In fact, I must say that there are regulators who are taking steps in terms of data, and we've seen one very much in a country like India, where the Reserve Bank of India has put out climate risk information systems as a stack that they are developing. So we will look for how to solve for that data, and of course unified frameworks for investors. I think that also would be useful. So since you mentioned that Akif will throw more light on how how this operates and how this is integrated, let me come to Akif. Akif, my question to you is, high-level decarbonization and net zero targets often feel disconnected from the day-to-day realities of NBFCs that are serving MSMEs and informal borrowers. I mean, informal borrowers and MSMEs, they're just struggling from quarter to quarter, correct? So how is then IPTC translating these ambitious goals into practical lending solutions that are accessible, relevant for the local businesses and communities? So tell us some more about the specific internal strategies or the capacity building initiatives that you have undertaken that have proven to be very effective and can be replicable and can enable the transition on ground. Over to you, Akif.
Thank you, Namita. So it is actually quite a timely session that we're having. I mean, given the fact that, Bangladesh as a country is accelerating its, green portfolio journey, the way that, the finance companies in Bangladesh, and of course, IPTC in particular, has been scaling up, is quite important that, the transition, the green transformation that we're having is a just one, right? So coming to your question regarding, the sort of disconnect that MSMEs, informal borrowers tend to have when it comes to concepts like decarbonization or net zero, right? So, like coming to the story of IPTC, so IPTC has had quite a healthy SME portfolio growth. Like if you compare between 2015 to 2020, it has been quite, we're a public listed company, so you can find the steps in our annual reports, but the scale of growth has been quite phenomenal. But when it comes to, focusing, if you take a look at the subset regarding in that SME portfolio, like, how the green SME portfolio, MSME portfolio, how that has changed over the years, the work becomes a bit more difficult, right? And that's exactly what you mentioned in the beginning, that there is some sort of dissonance between regarding such concepts when it comes to MSMEs. Now, the problem is that one of the challenges that we face when particularly when we approach our MSME clients is that there is a lack of awareness regarding the type of the environmental impact that their businesses have. So a common conception that MSMEs have is that due to the small size of their businesses, their environmental impacts tend to be less, which is of course not necessarily always true. But on the other hand, companies which are interested in taking green projects, they're somewhat like many of them are taken aback by the high upfront costs of such green projects, because as you mentioned that some of these businesses only have that quarter-to-quarter view instead of that long-term view because of their finances, their liquidity, and so on. Now, instead of waiting at our desks and waiting for the SME clients to come in and submit their green proposals, what IBTC did is that it adopted a relationship building model. So what we did is that we dispatched our relationship managers all throughout the country, and what they did is that they approached the clients, the MSMEs, the small businesses, and pitched and introduced the green lending solutions which are catered to them, right? And this is something that did not only take place in the capital in Bangladesh, but all throughout the country, so that our green lending solutions is covered geographically. But moreover, like and as a result, our green CMSME portfolio actually rose quite a bit, which led us to actually have a dedicated green financing target for CMSMEs in this year. So what we did is that, out of all the green finance disbursements that IBTC intends to make this year, at least a quarter of it has to be dedicated to the CMSMEs. The success that we had when it came to the green financing for CMSMEs can be attributed to capacity building of our relationship managers. So what we did is that we undertook a holistic training program for those who are involved in this entire process when it comes to MSME lending. So we of course trained the field officers, the relationship managers who are facing the clients and explaining the solutions to them. We also, on the other hand, trained the risk analysts, the credit risk managers, who also assess the files, so that they also have incorporate MSME as well as green lending perspective in their analysis. Interestingly, that's the internal capacity building that we undertook. Interestingly, what we also did is that we went to the clients and trained them as well, not just existing clients, but also potential clients. So we undertook a collaborative approach and undertook a series of training sessions where we introduced the green lending solutions, why undertaking green projects is necessary, and how it will actually lead them to have more sustainable businesses as they go on. So that's about it from our side to answer your question.
No, that's indeed great. I think, this is a great way to mainstream green, I would think, and I have done that, so I can relate to it very well. We always had this challenge of the stickiness for that customer segment, right? As a large bank, we were not very competitive in our interest rates when we competed with public sector banks. And one of the things was the green lending for energy efficiency, which helped us bring in that stickiness with the client. So that's a great way to do it. And thanks for sharing that. I will come back to you. Let me go to Abhishek now. Abhishek, of course, has been on this path maybe for a decade now. So he knows green very well with as the CEO of, Caspian Debt, which was one of India's first NBFCs to adopt the joint impact model, disclose on financed emissions using PCAF. So in one of my first interactions with Abhishek, when he mentioned PCAF, I was a little surprised because I don't think most CEOs of NBFCs will not know PCAF. And the way he said it, I knew where he was in his journey. So Abhishek, drawing from that journey, what do you see as the key structural and behavioral barriers that NBFCs would face when they are trying to make these kind of alignments to just transition goals, and balancing that with financial viability? So share with us what are some of the challenges from a practitioner's perspective. What are some of the strategies, institutional shifts that you found to be very effective in overcoming and bringing that balance? Over to you, Abhishek.
Yeah, thanks, Namita. And just to be sure, I'm still not very far in the green journey because I'm still trying to figure things out. So it's very complex. And I guess that essentially is one of the structural issues that make it very difficult for NBFCs to adopt these practices. But if I'll probably talk about the data and the complexity around the science and the implementation a little later. But if you look at it at a high level, an NBFC or any commercial entity will take up measures of this sort only in three conditions. The first being they are currently getting affected and they are seeing the financial impact of that right as of today. That is number one. Second is they have an incentive. So for example, low cost funding or some market that they were not able to tackle, or they have a stick, like a regulatory stick saying that you get this done, otherwise you have to pay a penalty. Now, as far as the first point is concerned, the financial damage, if I may, I think the financial damage from climate related issues is just starting to happen. So to be honest, even about 3 years ago, if you went and told an NBFC CEO that, the climate risks are, real, it will affect your portfolio, they would say, no, nothing would happen. But then in the last couple of years, for example, there has been quite a few cases of floods and droughts, both, and untimely rains that has led to crop failures, ultimately affecting loan portfolios. So now if you go to any Indian NBFC, I think by and large, people are aware, or at least they are admitting, yes, some part of our portfolio is getting affected. So that first thing is started to happen. Now, as far as the regulatory stick that is concerned, that is also, in my opinion, a lot of the good things as far as financial institutions is concerned needs to be pushed by the regulator to put things in order. And I think the regulators have been actively talking about this for some time. And this year, I think they've come out with much more clarity on what they like. But I think a lot more is needed. And to be honest, if the regulators hadn't started getting active in this area, I think it would have been very difficult for NBFCs to really justify action in this, because their shareholders would ask, why are you doing it? Why are you wasting time on things like this, right? The third aspect that I said is on the carrot, the incentive. Now, there is a lot of discussion about climate financing, hopefully cheaper financing available. So a lot of the NBFCs whose life and depends on getting access to financing, a lot of these NBFCs today are slowly realizing that, if I do take these measures, I might become an attractive opportunity for a climate-focused investor or a lender, particularly the DFIs or the multilats, who are the ones who generally have this kind of capital in large amounts. But if you really look at the reality, while the regulator is moving ahead and the NBFCs are realizing that there could be climate impact on my portfolio, so I need to do something about it, the access to climate financing is not getting easier, especially for the smaller NBFCs. And my work has always been with the smaller sized NBFCs, Typically what ends up happening with them is because of the size related constraints, multilateral development banks or DFIs typically don't like to deal with them. So ultimately these NBFCs go on and have to work with domestic financing institutions. And till the time the domestic financial institutions have an incentive to really fund them at a better pricing because of climate considerations, I think it's very difficult for NBFCs across the board to adopt these policies. The second part, of course, is the complexity of the science and how it really links to it. When we tried to implement it, I had a tough time. I went back studying, brought in a few people from my team to study, to understand where the risks are. We tried to figure out what are emission factors. We realized Indian emission factors for different types of specific industries, there was no clear number. There were regional numbers. And at the same time, greenwashing, the noise around greenwashing was big. So we realized that, we might put in all this effort and decide, figure out a method to quantify our financed emissions. But then at some point of time, somebody might just come and say that you are doing greenwashing. This is all nonsense. So we needed a solution. And that's the situation when I came across PCAF, looked at their framework. Even that was complex. We found it very difficult to implement. That's why GIM came in. And the GIM tool essentially helped us simplify the process of kind of quantifying the financed emissions based on whatever data we had on our portfolio. It reduces the burden of proof in some sense. It enables us to take the first step towards starting to measure. It is not the exact measure, but I think to a great extent, it helps you take the first step, build awareness amongst your board, amongst your team, amongst the shareholders, that this is probably a good first step to take further measures in this space, because whether you like it or not, climate-related risks are going to affect the business sometime down the line, and you better do something about it. So I think that's broadly the construct that I took, and those are the kind of practical issues I think NBFCs face. Over to you, Namita.
Thanks. I think this is so true. I mean, it's well said as a practitioner. The situation or the stick or the carrot, it is one of it that makes you move towards it. But I think the smart ones have taken it up as a business opportunity, and there's huge business opportunity if you can put your risks models well. Of course, there is a lot of regulatory action. We don't want the regulatory action to be like a tick box exercise, because many times that's what it turns out to be. And hopefully not in this case, but it makes a good question for Christine then, given that ADB and, MDBs are doing a lot of support to formation of national green policies across Asia, a lot of regulatory and policy interventions. So my question to you, Christine, is how do you consider all of this when it comes to systemically integrating it into NBFC lending? How do multilateral development banks best support governments in designing and implementing these kind of frameworks, taking into consideration, one is that there is a large segment of the society or business community out there which don't have the wherewithal. So over to you, Christine.
No, thanks so much. And it is a difficult challenge to integrate this into national frameworks. So first, let me talk to you a little bit about, what we do from this high level. So kind of key areas where we're active through our regulatory policy and interventions are through green taxonomies. Second is data platforms, and then through our knowledge sharing and regional cooperations. So for instance, on green taxonomies, we're working with the ASEAN Taxonomy Board in developing the ASEAN Taxonomy for Sustainable Finance, which then will serve as a regional framework to guide sustainable investments across Southeast Asia. So the taxonomy is designed to be inclusive and science-based. It helps countries then channel capital towards activities that support climate mitigation, adaptation, biodiversity protection, which is becoming increasingly important for us, and then circular economy transitions. And ADB has then also helped to integrate social safeguards into the taxonomy. So aligning it with just transition principles and ensuring that climate action does not then adversely affect vulnerable communities. Then building on the ASEAN Green Taxonomy, we work with the ASEAN Capital Markets Forum. We've been partners with them for over a decade. We've helped to develop and issue a regional ASEAN Transitional Finance Guide. And then at the national level, kind of diving down to give you an example there, for instance, we are supporting Thailand through a Thailand taxonomy, which was launched in May of 2025, which is really a key milestone in mobilizing climate-aligned capital and then guiding financial markets towards achieving inclusive and sustainable growth. And then we're also working with private sector clients, though, to integrate taxonomies into their financial sector strategies. So I had talked about, the earlier example of the microfinance program. Well, we're also working with larger clients. So, for instance, in Thailand, we signed a $150 million blue financing agreement with Thai Union that's aimed at enhancing the sustainability of shrimp production, for instance, in Thailand. And this was developed, this blue finance framework with ADB support. It was along with both the ASEAN and the Thai taxonomies. And then the last example, we're working heavily in Mongolia with a climate-based policy loan, where we're creating enabling regulations and policies to help mobilize public and private and carbon finance. And that's going to cover the entirety of the finance sector, including NBFCs. So those are some of the examples about how we take and work with taxonomies on both the regional level as well as the country level. Then secondly, in terms of climate and ESG data platforms, as people have pointed out already today, NBFCs often lack access to reliable risk and ESG data. It's often difficult for them to collect the data and then also maybe understand it as well too, but it's very critical for attracting international and multilateral investments. So what we're doing is we are providing that capacity building through technical assistance, through donor financing to help central banks and then regulators, which are typically provided with our policy-based lending modalities, for instance, to integrate climate risk assessments into financial decision-making, develop and then implement climate scenario analysis and stress testing frameworks so that they can really understand in the financial sector, what's going to be the impact of future climate change, to accelerate that understanding, promote climate-related financial disclosures, and then develop prudential policies incorporating climate risks. We're also working with governments to build actually a just transition support platform, which we talked about and launched in 2022 at COP27. And through this platform, ADB is providing technical assistance to help governments then assess socioeconomic impacts, design inclusive policies, and then build institutional capacity, including training and capacity building for financial institutions, including NBFCs, to integrate climate and social risk into lending practices. So a lot of carrots there. Then last is ADB has a large role, like the other multilateral development banks and bilateral banks, in terms of knowledge sharing and then regional cooperation in these partnerships, really to raise awareness about these issues and potential solutions. So we have convened various different expert platforms. So for instance, we have every 2 years, the Asia Finance Forum. There's one coming up at the end of September. We have an Asia Clean Energy Forum as well to share best practices and lessons learned. We're also one of the founding members of the Asia GX, which is the Green Transformation Consortium that was launched recently in 2024 of October. And that is supporting the development of transition finance frameworks that are tailored to unique economic and then energy contexts of our Asian countries. This is really a multi-stakeholder initiative, and it's aimed at advancing transition finance in Asia and, importantly, through the financial sector as well as other sectors to help bring in capital flows and then raise awareness. So it's through these different types of, avenues that we support then on a higher level some of these regulatory and then data as well as knowledge sharing issues to really support NBFCs in terms of their just transition.
Great. I think that's a lot of information. I think, Christine, we should do one session just for ADB to talk about all of this. I think that would be really
Happy
useful.
Happy to.
Because
I've left out, and I'm sorry, because we don't have enough time, and but I've left out also a little bit more of the technicalities around, blended finance that's being used out there, which is so critical for NBFCs, again, bringing in the carrot, right? As well as some of the solutions that we need as MDBs and others need in terms of first loss positions. So donors should be more flexible because first loss is very critical for us to even cover our own credit risk.
Yes. Yes, no, I think I'll take that up, and we'll circle back to you. We should plan something like that. Let me go to Laya, and I'm just keeping an eye on the clock. We have exactly 14 minutes to go, so I would request the other three panelists to just limit yourself to 2 to 3 minutes of intervention, because we also have some interesting questions for you, which I want to take up. So let me quickly go to Laya. Laya, how does the Jim Foundation support financial institutions in navigating this complexity of both the positive and unintended consequences? Because in the real world we live, there's a lot of multifaceted aspects of the real world, and what I would like to know from you is a concrete example of how Jim has helped connect financial performance with inclusive development outcomes. Over to you, Laya.
Thank you, Namita. Yeah, I will try to keep it short, but to kind of summarize this whole thing, the Jim wants to make it simple. From the foundation, our goal is to make it simple, make life easier. An example, for example, will be adaptation finance, which is kind of also in touch with the just transition, right? You need to adapt, you need to keep the jobs, you need to keep the well-being. From the FFIs, so the European DFIs, only between 1 and 5% of their investments are going to adaptation finance, which is definitely way less than needed. We were thinking, okay, how can we make this happen? How can we make this flow? Climate risk. The DFIs want their clients to assess climate risk, so they can direct this adaptation finance where it's needed. So we were like, okay, then we have a climate risk module. What else is needed for just transition? Knowledge, data is needed. So what do? We cannot be everywhere, and we are not the experts on in ground situations as other parties can be. So we partner up. For example, as it was mentioned before, we partner with the FCTO and in-ground experts to provide the Bangladesh program that through we met Akif. We are now in touch with Sustina, Eco Advisors. I think Mr. Abadani is also in this call to see how can we help in the situation in India. What's needed, we will provide it. So that's kind of how we are aiming to bridge this financial just transition gap, making all these available. The GIM is aligned with PCAF, ISSBS too. The idea is there are a lot of policies. It's a complex landscape. We don't want to add to any of that complexity. We want to make it simple. You can a very specific example could be, for example, you can look at your emissions. You can look how much you're emitting with a specific client. You can also look how many jobs this client is supporting and how much is adding to the GDP of the country. You don't want to say, oh, this investment, I'm not going to invest in this client anymore, too many emissions, I want to go to net zero. That's not the approach. The approach is that you may have a client with high emissions, but this client may be supporting a lot of jobs. What the GIM enables you to do is go talk with your client, work together on strategies to decarbonize while maintaining those jobs, maintaining the value added, and making this work. So I think, yeah, I don't want to go any further. I know we're short in time. So that's
No, this connected approach in terms of looking at appropriate gaps and appropriate solutions, I think that's really good. And let me go to Akif. Akif, over years, tell us, how has IPDC navigated risks and opportunities associated with just transition finance, particularly in a country like Bangladesh, where you are balancing climate goals with financial stability. So tell us more about how you have been able to do this. What's been most critical? How have you engaged in innovative partnerships? Because I hear that a lot from Jim folks also. So why don't you elaborate on that?
Right. So regarding, when it comes to the challenges that we have faced when it came to just transition financing, right? So when it came to, so far we have been scaling up our green portfolio, but a huge chunk of them is, a significant chunk of that portfolio falls under energy efficient machineries and energy efficient machineries, right? So when it comes to, talking about purchasing machineries in factories, in workplaces, we tend to look at, how the workers are going to be affected, right? Because as you can understand, many of the industries in Bangladesh are quite labor intensive, and companies have an incentive to maximize their efficiency as well as, control the costs. This is whenever we try to finance we're undertaking a financing decision. What we have been recently doing is that we're also taking a look at how the impact is going to be on the workers, on the communities. That's exactly, and that's exactly where the GIM tool comes into play and helps us to assess the social impact of the financing decisions that we're taking. Now, this is just one of the collaboration that IBTC has undertaken, the one with the Joint Impact Model Foundation. On the other hand, what IBTC has also has been undertaking is that we collaborated with NGOs to ensure that just transition finance are properly disbursed. For example, last year we partnered with an international NGO where we have contributed to climate resilient, sustainable agriculture in vulnerable communities in the north of Bangladesh. On the other hand, what IBTC has been doing is that it collaborated with the regulators, concessional finance for green projects. So Bangladesh Bank has a green concessional fund, which helps especially the MSMEs to undertake green transformation projects at a lower cost. On the other hand, especially keeping in mind that the investment projects the green investment projects that IBTC takes are just, we are also considering collaborating with the Challenge Fund to ensure that to ensure transition financing in RMGs where women are trained and equipped to operate the new machineries that are being undertaken. So these are some of the examples that IBTC has in recent times when it comes to collaboration for just transition financing.
Yeah. I think this is really brilliant, and all these are very replicable models that can be looked at. And let me go to Abhishek very quickly. Abhishek, drawing from your past experience, I want to ask you what kind of or which financial models, inclusive finance, micro enterprise support, catalytic capital, which has proven to be most effective at bridging this resilience and social inclusion gap. So if you could share an example of where these collaborations, where these kind of models have unlocked tangible impact for the communities, and also at the same time helped in expanding the balance sheets. Over to you.
Sure. No, and this is a complex thing, and I think one thing that I have noted in my association, for example, with Dwara or Andy, for that matter, if you look at the Dwara model, it is a venture builder that essentially looks at building commercial ventures, but has incredible amount of patience and expertise. So Northern Arc Capital came out of the Dwara stable, and if they didn't have the patience to build that model, fine tune it for the first 6 years, I don't think a Northern Arc Capital could have come into existence. And now that has created a template for other organizations to replicate. A very similar thing, I mean, we are trying to do a similar thing at Dwara on the health finance side and agri-finance side as well. And certain things are planned at the climate finance. So in a way, I'll say patience and technical expertise, that combination is deadly if applied properly. But it's very difficult to do. That is one. If you look at the Andy approach, it's a very ecosystem development approach. They're trying to bring multiple people together. So as I speak, I'm actually on the jury of a innovation fund that Andy is running, where they brought in a philanthropic organization to fund or support incubators and accelerators to develop different types of financing models for clean technology companies. Now, there are different types of examples, different types of proposals that we've got. So one proposal, for example, is how to help NBFCs do asset financing for climate smart, technologies. It is something that is new. It is difficult to do. The product structures are unknown. But what Andy is trying to do is basically, bring that expertise and try to say that, can you basically pick up some of these ideas and then give it over to the commercial sector so that their the time to learn the whole thing is cut short, and they can just go ahead and do it. There are other models like, of supporting funds to basically help and grow climate technology companies faster in how they can work with financial institutions. But all of this is happening with philanthropic money. So a combination of, I would say, some versions of what you call blended finance today, but also some version of patience execution to essentially develop and fine-tune models which can then be scaled up. If you expect climate-related solutions to be growing 100%, 200% year on year right from the first day, I think that's a mistake. You need the initial patience to build a strong foundation, and then you expect the commercial growth or growth of balance sheet like you were talking about. That's all from this.
Yeah, no, I think this is very, very important. And I picked up the technology part of it. So I sit on the board of another NBFC where it's affordable housing and where loans get approved within 5 minutes of first-time women borrowers logging into the systems, where there is a risk management approach that has been put, which reduces the feet on the street to do the evaluations, which is a very good thing, right? And there are so many models like that that can be replicated. Great. I think this was good. I'm just looking at the questions, and due to the paucity of time, I'm just going to pick up one question that is relevant here. I mean, others are also relevant, but this is most apt to anybody on the panel. The question is, business models, when focused on just transition, seem to be considered not very commercially viable and are considered NGOs at times, so not profit making. How should entrepreneurs prove their business case in scenarios where they are currently in negative margins? So basically, how do you access finance, where it's in a way where commercially viable models need support? Anybody on the panel could answer that question.
I'll try to make an attempt.
Yes,
so,
please go.
So the thing is, I don't know about the negative margins, but I can talk about basically situations where the losses are high because you're trying to serve a client segment that doesn't have the ability to pay, or your cost of reaching that customer is very high. I have seen models where, at least in the Indian context, CSR funding has been brought in to meet the cost of reaching out to that customer, or providing this, bearing a part of the cost of the product to that customer. So there is a blending that has to be done. You have to admit that you may not in all possibility in all situations be able to serve at cost in a commercial basis. So bring in the soft capital providers. Easier said than done, but it has been done.
And maybe if I can just add, so at ADB, some of this technical assistance that's funded by donors that we bring for capacity development, it's also for new product development. So we've done that, many years ago for gender financing, for instance, to show maybe banks or NBFCs the opportunity with women. Well, we're also doing it with green financing as well, too, either specific products for them or helping them look for market opportunities. So financing that more kind of pioneering work that we would like to support.
Yeah, no, I think that's a good input. I would think that such models need the support of some kind of blended finance, and you have to look for what is the right facility out there which you could match. I think there is a financing stack in every sector, and as just transition as a sector is maybe at the base or the mid level of that financing stack, which needs a lot of concessionality, which needs a lot of support to be able to become commercially viable. But great, it was a fantastic panel today, a lot of learning, and I think it deserves to have a session of its own to be able to decode this, and we will come back to you with our partners, and hopefully we'll do that soon. Thank you very much, and over to you, Ritu.
Thank you, Namita, and all the panelists for your enthusiastic participation. We are approaching the end of the webinar. I hope you enjoyed the session as much as we enjoyed hosting it. The conversations were very riveting and provided us with a lot of food for thought. Please keep an eye out for the insights from this webinar on LinkedIn. With this, I would like to thank our partners, Jim Foundation and Grantham Research Institute on Climate Change and the Environment's Just Transition Finance Lab. Thank you very much for joining us today.